A recent Moody's report maintained Canada's AAA credit rating, but it also highlighted some major red flags for the Canadian economy. Joining us now to help shed some light on those risks, here's Craig Alexander, Senior VP and Chief Economist with the TD Bank Group. And Craig, it's always good to have you on the program. Thanks for coming back in. Initial reaction to Moody's leaving the AAA alone?
Well, no surprise. I think when you look at Canada's economic fundamentals, they look quite good. We're experiencing moderate economic growth. It's leading to a gradually declining unemployment rate. And from a fiscal point of view, when you compare the Canadian federal and provincial finances in aggregate, and then you compare it to some of the challenges that we're seeing in Europe, and in fact some of the challenges in the United States, I think that Canada on a relative basis actually looks very, very attractive. And so as a result, Moody's is basically saying that, that the debt of the government of Canada is very, very safe.
Very, very safe, but they did raise a few red flags. We alluded to the housing market issue, the household debt issue. How urgently do you think they're waving those red flags?
Well, I think that they are basically doing their due service as a credit rating group to say...
You mean in a way that they didn't do during the Great Recession?
Well, what they're doing is
he says parenthetically. Anyway, go on. Yeah.
Well, they are being more vigilant if you think about what's happened with credit ratings in Europe, right? They're looking at government finances and being very critical about them. They don't want to miss the risks that are out there. And when we look at Canada, it is clear that there is some imbalances now. That doesn't mean the imbalances will be unwound in the next year or two. It means that there is something that inherently is a bit unsustainable going on. And I think that it's directly a byproduct of the remarkably low interest rate environment we've had for such an exceptional length of time, which has boosted real estate values and also encouraged people to take on debt. Now, it doesn't mean that you're going to have a US-style problem. We don't have a credit bubble like the US developed, but it does mean that there is some risks there, particularly when interest rates ultimately head higher.
Which everybody says they're not going to do for a very long time, though, right?
Well, and I think that's one of the reasons why people have acknowledged that there are these risks, but at the same time, you don't have a catalyst to cause an unwinding of them. Because it isn't the case that one day people are just going to wake up and say, oh, we're all going to run out and sell our houses, or, if interest rates remain at current levels, Canadians actually can meet their financial commitments. So the real question is, what happens when rates go higher? But the clear message from the Bank of Canada is that they're in no rush to raise rates.
Right.
And in my own personal view, when they do raise rates, I think it's going to be done in a very gradual way, and probably a segmented way, where I think that what they'll end up doing is they'll raise rates a bit, stop, and then say, okay, so how did the economy respond? How did the housing market respond? Okay, if everything's all right, well, we'll take rates a little higher again. So my expectation is the Bank of Canada probably won't raise rates until well into the second half of next year. And even then, I only think about a half a point increase. And then probably they pause, wait a while, right? See what happens. And then if they think that the economy is still capable of weathering higher rates, then they'll nudge them up again. So basically, I think the Bank of Canada is going to have to wean people off the drug of cheap debt.
So the catalyst, as you put it, is not there today. Having said all that, in your view, how much household debt is too much?
Well, if we look at the growth that we've seen in personal debt, it has been very rapid, and it has increased much faster than income. So as a result, if you look at the debt to income ratio, it's currently at 164%. And if we went back to the early 2000s, it was about 110%. But the problem you have as an economist is there isn't a line in the sand that says this is where you should be, like this is the optimal amount. And the reason is because you have to have an interest rate assumption. So if we think back to the 1980s or early 90s, when interest rates were dramatically higher, and they also fluctuated a great deal. So you could have a situation where you take out a 5-year mortgage, and then 5 years later you go to renew, and mortgage rates have moved by 3-4 percentage points. So how much debt are you going to carry in a high interest rate, high volatile interest rate world? Now compared to today, you have very low interest rates, and when interest rates move, they tend to move in small increments. So the natural thing is the equilibrium, or the normal amount of debt you're willing to carry, is actually going to be a lot higher than it was in the past. But we don't actually have a line in the sand that says, okay, you've gone too far.
Okay, but tell me this. I think everybody would agree that if you've gone out and bought 500 flat-screen TVs and that's why you're in debt, that's stupid debt. But if you've gone into debt to buy yourself a home that may have cost a fortune, if you asked your parents, it may have cost a fortune, but you can kind of manage it, That's okay debt, isn't it?
Well, we differentiate between good debt and bad debt,
Right.
and bad debt is basically debt that's financing consumption or assets that aren't going to retain value. Whereas if you're actually putting the money into an investment in a house, you can make the case that those principal payments are like a forced savings plan. Your personal net worth is going to go up. And one of the things we actually have seen over the last several years is that while debt has climbed, the value of assets has climbed as well. And in fact, have far outpaced the increase in debt. So on a net worth basis, Canadians are a lot wealthier. They've taken advantage of low interest rates when the Bank of Canada provided it. Keep in mind that the reason why those rates came down was to help the economy at a time when it was struggling. And you know what? It worked. The financial system was open for business. People borrowed. They took advantage of low rates, and it helped to boost the economy. It's been a core part of the economic recovery.
I'm sensing a but, though. But there comes a time when...
Well, the point is that interest rates can't stay at these levels indefinitely. Now, I got to be honest. I feel like the little boy that cried wolf, because every year I say, 12 months from now, we think interest rates are going to be higher, and then 12 months later, they haven't gone up. In fact, they've actually gone down often over the last several years. So as an economic forecaster, financial forecaster, you feel a little like the boy that cried wolf. But I encourage people to go read the book. The wolf does show up at the end. You just don't know how many chapters there are in the book.
When is the end? We're not sure. But in your view, how strongly do personal debt levels that Canadians are carrying on average, how dramatically do those debt levels affect the economy overall?
Well, it is significant because, and this is one of the reasons why the Bank of Canada in their financial system review have identified that they're concerned about household debt and elevated home prices. So the Moody's flagging of these risks is not unique, right? This is a broad-based, well-recognized risk in the economy. So the real question is, when interest rates rise, how much of an impact it's going to have. The consumer is 60% of the economy, so clearly you worry about what will happen to consumer spending. I would argue that when I look at the numbers, I think when interest rates go up, unless they go up dramatically in a short period of time, I think the effect on the household sector is going to be very much like a gasoline shock, right? Interest rates will go up, and suddenly people will find that after they meet their financial commitments, they'll have less money for other purchases. And that can actually slow down economic growth. And I think that's where the big risk is. I don't think that the data supports an argument that says when interest rates go up, we're going to have a US-like experience where people are going to lose their houses. The analysis done by the Bank of Canada, which my team has replicated as well, is that if interest rates were to go up a couple of percentage points from current levels, what would happen is you'd go from about 6% of Canadians having more than 40% of their debt going to service, or more than 40% of their income to go to service their debt, which is really sort of a threshold you worry about, because beyond that, people really run into difficulty. That ratio goes from 6% up to about 10%. So this is not the majority of Canadians. The majority of Canadians have actually have behaved in a very responsible way with their debt, but they have taken advantage of low rates when they were present. There are some people that have overindulged, as you might expect. The low level of rates that we have today is a little like an open bar at a wedding. Right? You expect people to behave responsibly, but there's going to be some that have overindulged. But I don't think the big threats that Canadians will lose their houses. I think when rates go up, I think it's just going to be a real shock. And what I worry about is young people actually think the rates we have today are normal because we've had them for such a long period of time.
And they're not. They're actually, in the grand scheme of history, they're unusually low for an unusually long period of time, right?
I think that well, first of all, we've never seen the Bank of Canada on hold for 5 to 6 years.
Right.
Second thing is that I think a normal level of interest rates is probably 2 to 3 points higher than we have today, which in level terms is not terribly high. But when it happens, first of all, I think it's going to happen gradually and incrementally, so it'll give people time to adjust. But make no mistake, it will be a shock to people when rates finally go higher.
Well, okay, let's play that out. If it is a shock to people when rates, as you have seen it coming down the pipe, a little bit at first, see how it goes, a little bit more potentially after that, that will have an impact on the housing market, which at the moment is just going up and up and up and up and up, in the Greater Toronto area to be sure. What potentially does a soft landing look like there? We hope it will be a soft landing, right?
Yeah, so I would say a soft landing in the housing market is one where home prices probably drop down to about the rate of inflation, so around 2% year over year. And after you strip off inflation, you're basically getting no appreciation after inflation.
What are they doing right now?
Right now, well, it depends on the market, because as you said, it depends on which city you look at. In aggregate, Canadian home prices are rising at sort of a mid-single digit pace. But when you look at certain cities, and in particular it's Toronto, Calgary, and Vancouver, you're still seeing a lot of strength, reflecting the fact that affordability is still good because interest rates are so incredibly low. And obviously the markets that would be the most at risk to higher interest rates are going to be the markets that have seen the biggest increase in prices. But at the same time, I do think that there are fundamental reasons why home prices have been going up in the major cities. So if you take the GTA as an example, because in the short run, there's lots of things that drive the housing market, interest rates, employment, consumer confidence, et cetera. But in the long run, what really drives real estate is population growth and land scarcity. And when I look
both in Toronto.
Right. When you look at the GTA, while Canada's population growth is going to slow, within a few years, 100% of population growth in Canada will come from immigration. Immigrants do not spread themselves equally across the country. And so they disproportionately go to the GTA, to Vancouver, and we're seeing more in the Calgary-Edmonton corridor. So those markets probably have very strong long-term support. You also have the Greenbelt around the GTA, which has effectively created land scarcity. And if you can't grow out, you're going to grow up. And that's why we're having the condo boom. But nevertheless, there is cycles, right? Home prices just don't go in one direction. And when interest rates go up, I do think it will cause a cycle in the Canadian real estate markets. So, on a short-term basis, as the Bank of Canada raises rates, I think you're going to get slower home price appreciation. You may get some contraction in selected markets. But in the long term, the markets where you have rising population and you have land scarcity are actually going to experience strength. So it's a very mixed story, right? In a long-term view, I think the GTA is going to do quite well. In a short-term view, I do worry that when rates come up, it's going to be a shock to people.
I wonder if part of it as well, and I know you're not a city planner, but the latest thing, if you like, in city planning is not urban sprawl as it was 20 and 30 years ago. It is intensification.
Yeah.
And as long as people want to build more in the existing urban municipalities, it's inevitable the prices are just going to keep going up if interest rates are low. Isn't that the case?
Well, if you think about, so why are home prices in Vancouver significantly higher than Toronto, right? And part of it is the climate and the location to orientation to Asia. But a lot of it is also land scarcity, right? You have mountains surrounding the city and you have the city divided by rivers with few bridges. So it puts a premium on housing in Vancouver. Well, Toronto didn't have land scarcity until the Greenbelt was really put around it. There was some land scarcity in the sense that the commute times were getting farther and farther and farther. So I think a combination of the sprawl combined with the Greenbelt acted to create a pressure to create densification, more people living in the core. But it's a virtuous circle because as more people live in the core, you had more businesses locate in the core to provide services to those individuals. And so it actually became a much more livable city in the core. So now you actually have young people with a very strong preference to live in the core. And as you might expect, this is the sort of thing that will drive prices higher because you have rising demand, right? And with low interest rates, you actually have had an affordable market.
And they may not have the money, but their parents may.
Well, and that's how the part of the affordability pressure has played out, right? Yeah. Because if the kids haven't been able to afford it, they've often had to go get financial help from others, including their parents.
Let's do one more thing here in our remaining couple of minutes, and that is $1 at 88 cents versus $1 lower than 88 cents. Can you play that out and tell us how that has an impact on our pocketbook?
So a falling Canadian dollar creates winners and losers within the Canadian economy. So a weaker Canadian dollar is very, very good for Canadian exporters. It improves competitiveness. And Canada is a very small, but one of the biggest trading countries in terms of the percentage of the economy that's exports around the world. We sell an awful lot. And in fact, Canada is very much an economy built on north-south lines, not east-west. In many respects, Canada's California, right? We have a population about the same size as California. Our economy is about the same size, but we're spread across the entire width of the United States. So as a result, the history of the Canadian economy is that we've been integrated along north-south lines. And so a weakening Canadian dollar, when we say a weaker Canadian dollar, you actually mean against the US dollar.
Correct.
And so it improves competitiveness, it helps boost exports in Canada, and that helps boost economic growth. On the other hand, it's bad news for importers. It's bad news for Canadians that want to do cross-border shopping. It's certainly bad news for snowbirds, and I hear a lot about this from my mother, right? And when I try to explain to her that on balance, when you go the winners and the losers, right, the export effect actually overwhelms the negatives to the domestic economy, and so as a result, on balance, a weaker Canadian dollar actually promotes growth. It creates jobs.
Where would you like to see it?
I actually am very comfortable with about where it is, right? I think that somewhere around, the 85 cent mark, somewhere in the sort of 82 to 88 cent range actually makes a lot of sense for the Canadian economy. And if we look at unit labor costs, so the cost of production in Canada versus the cost of production in the United States, that's, in that range, Canadian exporters can deal with the currency. The other thing, though, is when you talk about the Canadian dollar coming down to 88 cents and potentially even going lower, and I do think it probably will drift lower in the coming months. It wasn't that long ago that we would have thought, a mid 80 cent dollar was actually a strong exchange rate. Right? Mm-hmm. It's only because we were at par that people actually think the exchange rate is weak.
Okay. Craig, we're going to leave it there. Thanks so much for your help on this tonight.
Oh, it's always a pleasure, Steve.
Craig Alexander from the TD Bank.
Support Ontario's public television. Donate at tvo.org.